We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lyn Alden, founder of Lyn Alden Investment Strategy. How are you today, Lyn?
Good. How are you?
Excellent. Thanks for joining me. So, in your most recent public newsletter, you analyzed the problems of how difficult it is to store a house sale equivalent sum of money for anyone, whether it be in a developing country or a developed country. So maybe we could kind of start around the discussion of the issues that make that such a difficult proposition to do, not only from an inflationary standpoint, but also maybe a financial censorship standpoint.
Sure. So basically, we can think of the global financial system as essentially a giant barter system. I mean, money's meant to solve the barter system, but because, instead of, one or two underlying monies, like say gold and silver, the current system has 180 different fiat currencies, of which something like 130 of them are free floating. The other ones are pegged, but pegs can break. And so you essentially have these 180 different local monopolies on currencies. And if you're just in a certain jurisdiction, that's what you're expected to save in, that's what you're expected to spend with. Mm-hmm. And that's what holds stable value relative to wages and average price levels in your jurisdiction, because it's all denominated in that. And wages tend to be sticky, and certain types of pricing tend to be sticky. And the problem, of course, is that, outside of, say, the top dozen currencies, most of them are pretty bad at holding value. I mean, even the top 12 lose value slowly, sometimes more quickly than others, but it's a general slow loss of purchasing power. But if you're outside of those top 12, you're more likely to lose value very, very quickly. And it's sometimes those jurisdictions fall, but it's also because those core countries push chaos to the periphery, right? Because they're the ones that have to borrow in say dollars, right? So instead of issuing debt in their own currency, they're often issuing debt in a foreign currency, which introduces volatility and default risk. And so the challenge is, if I asked this question because I actually have family in Egypt, and they were looking to sell a multifamily home. Mm-hmm. And of course, different participants that own parts of that home want to have different timelines for when they might deploy that into whatever they end up owning next. And so I asked the question on Twitter. I was like, if you had to sell property in a country with a currency crisis and hold that value for whatever reason for 2 years, how would you hold it? And it just showed that the nature of that question is one, a lot of people in developed markets don't think of that. And it just shows how inefficient the current system is, because some people are like, well, we'll just hold it in dollars. It's like, well, where are you going to hold the dollars, right? If you're in Egypt or you're in Argentina, where are you going to hold the dollars exactly? Are you going to hold them in your local bank where they could be confiscated? You could have a foreign bank account, but then that implies you're kind of wealthy, right? I mean, not a lot of people don't even have domestic bank accounts, let alone foreign bank accounts. Mm-hmm. You can do stable coins, but then you're relying on a foreign counterparty, which many people, stable coins are a temporary answer, but it's not a perfect answer. Some people hold it in gold, physical cash dollars, but then you're literally holding like a lot of value in your apartment. You're prone to theft, prone to loss. And it just shows that, basically there's a lot of frictions around one. It should be able to store value stably, but it can't. And so I was kind of used that as an example to show how in the 21st century, how basically still inefficient and unable to meet the needs of people, the global financial system still is.
Mm-hmm. Yeah. And it's really interesting, reading through that article, you give the example of how the Egyptian pound really got, devalued by 50% overnight. And some of these challenges that really face people that maybe, as you said, there's a lot of investors that don't necessarily think about that on a day-to-day basis. One of the other parts of it was that you brought up was financial censorship. So how does that play into it as well, Lyn?
Sure. So approximately 50% of people in the world live in what is classified as an authoritarian country. And of course, the exact definitions can change depending on what source you're looking at, the exact threshold where they make that differentiator. Freedom House, for example, puts it in 3 different categories. Every country gets like a score along these different levels of freedom, and then they're broadly classified into free, partially free, or not free. And unfortunately, about half the world lives in countries that are, not free or very minimally free.
Mm-hmm.
And the problem there is that there's pretty arbitrary rule of law. If you do something that the government doesn't like, they can just freeze your money, confiscate your money, and there's not necessarily recourse. There's not necessarily a separate, a distinct judicial system to you basically make sure that there's fair treatment for everyone, that there's rule of law. I mean, that's a hard enough concept in some of the countries with the best rule of law. It's still never perfect, but it's far more unlikely to happen in a lot of countries. And so, obviously Canada was a recent example in what is, a developed country, that there's bank freezes associated with protesting. Mm-hmm. But there's also, I've directly spoken with, for example, Nigerian protesters. They were protesting police violence in Nigeria. And many of them had their bank accounts frozen for protesting. And so that then, for example, they were turning to Bitcoin to basically still be able to collect donations and then make outlays, because they're kind of going around the banking system. I also talked to someone who worked on Alexei Navalny's team. Basically, now he's in jail, but he was Putin's opposition in Russia, basically an anti-corruption lawyer. And they would have their bank accounts frozen, and they would turn to Bitcoin again. And then the funny thing is, the government would then open their bank accounts because they'd rather see the money flowing through there and at least see where it's going, rather than it all be over in like Bitcoin or stablecoins or things like that. And so basically, in addition to the loss of purchasing power, inflation, many people in many countries struggle with banks that can just censor them, governments that can tell the banks to censor them, difficulty making global payments. Like, let's say you work in a country in Africa and you want to do graphic design work for someone, and they have trouble paying you because you're trying to get two different systems to operate, and then there's like all sorts of checks and regulations that are stopping that money flow. And there's a lot of frictions in the global financial system, both for authoritarian reasons and for inflation reasons.
So did the challenge of moving physical assets like gold and silver end up being, an inefficiency that ultimately led to the abstraction and financialization of the system of account that we've relied upon for centuries?
Yeah, that's a case that I made, that essentially there's a speed mismatch between commerce and money. And so if you go back prior to the 1800s, literally for thousands of years, money and commerce moved at the same speed, which is the speed of people, which, foot, horse, ships, that's about as fast as you could move. And that include both commerce and the actual money, whether it's gold or silver coins, or even like if you had banknotes or ledgers, you still could only transport that information the same speed with which humans are moving. But starting with the telecommunication systems in the 1800s, the mid 1800s, invented the telegraph, then the telephone, and then we laid the undersea cables starting in the mid 1800s. And at that point, banks around the world could update each other's ledgers, in the same day. And so you basically had the speed of commerce could now be as quick as a phone call, which of course was then later accelerated with the internet. Let's just say even the phone call, while the settlement of underlying assets was still moving at the speed of gold or physical banknotes. And so that allowed governments and banks a lot of arbitrage. They basically arbitrage that speed difference because they say, okay, we have to abstract gold. We have to have banknotes that are backed by gold. And then those banknotes, even though those are physical, they're tied into this ledger system. That is a global telecommunications, enhanced ledger system that can move around very quickly. And then once you centralize everything, you can just break a pen. You can rug pull people. And that's what happened. That was kind of the whole story of the 1900s, especially, the first half of the 1900s, just a series of rug pulls, no matter where you were. And so that's kind of the speed mismatch that we've been in for a while. And I think that's a big reason why we have the fiat currency system, that nothing else has really been fast enough to keep up. And so gold is still useful as a savings asset, but it's not been useful as, say, a far distance payment asset. And it's just we have this kind of speed mismatch out there that allows these systems to exist, despite the fact that they just keep losing value.
Mm-hmm. Obviously, cryptocurrencies and you had mentioned earlier, stablecoins have become, a major solution to this problem. But is dilution of many of these cryptocurrencies that have popped up, let's say, since Bitcoin's inception, one of the biggest issues that have plagued users of many of those alternative currencies?
Well, so I'm not bullish on crypto as a whole. I found value in Bitcoin. I think the design of basically it's the truly decentralized one, and it's got very strong network effects. I think stablecoins are serving a purpose for people, as we just discussed. Outside of that, so I think that some of those cryptos do slow down the say adoption of things like Bitcoin and things like that, because during a bull market, anyone can create a new coin. You can divert capital for all these different things, and then in a bear market, most of them get wiped out. They give up a lot of their gains, and they never really make higher highs in the next cycle. So I do think that there's a lot of dilution in that sense, but it's one of those things where, no matter how many pesos Argentina prints, that doesn't dilute the dollar, right? And so, for example, no matter how much Dogecoins exist, it doesn't dilute Bitcoin, because they are different. They are fundamentally different designs, different hash rate, different node networks, different levels of ecosystem development and general seriousness. But it does divert capital, it does slow down adoption. And so that's one of the Achilles heels of say Bitcoin and broader crypto, is that, much like how you can't really copy Wikipedia. Like you can copy all the data on Wikipedia. You can host Wikipedia on your own website, and you can have all the data. There's actually not that much data. You can fit it in a thumb drive. And then the question is, would you get traffic that Wikipedia has if you did that? Of course, the answer is no, because even though you can replicate all the text, you can't replicate all the links. You can't replicate the army of volunteer editors. But if people made 1,000 fake Wikipedias, you would divert some traffic to those, at least for a period of time. And we kind of see that cycle after cycle as the world explores this technology. And so I do think dilution is kind of it's always an intermediate concern throughout the space.
So with all of the issues that we've seen with crypto, as you said, like we've had in some ways a loss of confidence because of some of this dilution, and obviously that's going to mean more regulation coming to that crypto industry, in the near future here. Do you see this as a net positive or negative for the industry?
I think it depends where you're looking. I mean, a lot of the crypto space has relied on regulatory arbitrage, right? So they're essentially securities. Mm-hmm. Basically, if you look at the Howey rule, they mostly meet the definition of securities. They're a centralized team, or fairly centralized. They're raising capital to then work on something that is, with their work, trying to contribute value to that and make those tokens appreciate in price. Mm-hmm. And so they've been operating in that gray zone. And I do think regulation would slow down them and take away a lot of the kind of the scams. But like if you look at traditional startup financing, right? So if you do a startup and you're either a developer, a founder, an early VC investor, you're tied to pretty much the success of that company, right? So you either need an exit, you need either a company has to come in and acquire your company, which means like serious business people will review your company to decide that they want to buy that and put it into their company, or you go long enough and big enough and then go through all the SEC filings and you go public, and then you can get exit liquidity. Whereas what you see in the crypto space is you'll have all these early developers and financiers. They will, they'll issue these tokens for themselves at super cheap prices. Then, they work on their project for a couple of years, and there's a hype cycle. They get their coins listed on an exchange, and then they sell to the retail public. And then their project never really goes anywhere. It never actually really results in a product that people are using any sort of consumer basis. Mm-hmm. And so you've detached the financial gains of the early investors and the founders and the developers from the actual success of the underlying project that they built, and that's not healthy. So I do think there's probably more regulation. It's unclear what it's going to look like. A lot of those can do jurisdictional arbitrage, so that if they can basically lose access to a large market like the US or have their access restricted, but they can still exist by going to certain other smaller jurisdictions that are more open to those sort of things. But overall, I think that does pressure the industry. When you look at, say, the Bitcoin only ecosystem, I mean, Bitcoin's not a security. That's something that Gary Gensler has been very clear about. There's no issuer, never raised capital. So that's more like a digital commodity. But most of what you see in the space is more like a security. You can think of it more like an equity that just hasn't gone through the same sort of registration process.
Mm-hmm. So what do you ultimately see as the solution to the value storage problem?
I mean, I think the market's storing that out, kind of sorting that out now. I mean, I think one of the potential long-term solutions is Bitcoin if it continues to do well, but that's by no means assured. Right now, the problem is that there's no perfect one, so there's a hodgepodge. I mean, that's why people have diversified portfolios because you store it in equities. They generate, if you pick profitable ones, they generate cash and dividends. You can also store it in real estate. I mean, the problem with all that is it's essentially non-custodial, right? You're tied into that country's ecosystem. It's not very mobile. You can self-custody gold. That's partially outside of the system, but good luck moving that around globally in any sort of sizable amounts as a bearer asset. Bitcoin's really useful, but it's 14 years old. It's very volatile, so you can't. Most people can't put all their money in Bitcoin, or it's hard to say exactly what Bitcoin's going to look like in 30 years. And so it's really about a bunch of existing options, a couple of newer, interesting options. And I think right now you have to kind of hedge your bets. You have to diversify a little bit based on your volatility profile and based on the research that you do. So I like a combination of precious metals, equities, some real estate, and Bitcoin, kind of this mix of different types of assets.
Mm-hmm. One of the points you bring up in that article too is trading maybe dollars or currencies for gold, or making gold more digitally accessible. So what are some of the important points of having that ability to in some ways digitize or having digital access to a hard asset like gold?
Well, so a couple of points. One is that let's go back to bank accounts for a second. Banks have been around for centuries. And in 20 years, smartphone adoption has now just exceeded bank account adoption. So more people in the world have a smartphone than a bank account. And probably in 5 years, that gap will be wider because the rate of smartphone adoption is increasing because of the exponentially decreasing costs of, the devices, especially the inexpensive ones, as well as all the infrastructure that allows them to have, mobile data. And so basically, that gives people global access to hold an asset, even a bearer asset, move it around, use the internet to exchange value, get financial services. And I think a basic premise is, why should it be the case that everybody who has a smartphone can access good money, access a global marketplace of monies, and get basic financial services, uncensorable payments, savings, things like that. And so, like, for example, one thing stablecoins do is they say, well, I mean, if you're an Argentinian and you want to hold dollars, you don't want to hold dollars in your Argentinian bank because they have a history of confiscating them. You could hold them on, you could hold them on a hardware wallet, and you hold stable coins on a hardware wallet, and you're still reliant on the issuer of that stable coin, but that issuer is not in Argentina, right? You've now accessed a global marketplace of dollars. And for some percentage of your savings, that might be a better risk reward than other things that are available to you. Mm-hmm. There's also been the same thing. We have essentially stable coins with gold, where basically instead of accessing gold physically, which I think is usually the best option, but if for some reason you can't, or you're traveling a lot and you want some gold price exposure, there are redeemable. There's kind of like an ETF, but instead of just trading for a limited period of time on an exchange, you have this globally trading token that represents redeemable claims for custodied gold. And so you've essentially abstracted gold, and now you have you still have counterparty risk, but you can choose what counterparties you want to work with and have that price exposure. And I think the last point there is, in the United States, stocks trade at about 19% of the time, right? So they only trade a handful of hours each day. They only trade 5 days a week. They don't trade on holidays. And when you add that up all together, throughout the course of a year, their trading hours are 19% of all the hours in the year. So the other 81% of the time, they're not trading normal hours. There's after hour stuff, there's futures, there's things like that, usually not accessible to retail as easily. And essentially what I think a reasonable question to ask is, why can't they trade 24/7 like stablecoins, gold-backed stablecoins do, Bitcoin, things like that? And then also, let's say you're in Nigeria and you want to own Apple stock. That's kind of hard to do sometimes, unless you're wealthy. Mm-hmm. But if you could have any sort of traditional security, be accessible to anybody with a smartphone, I think it opens up the types of assets that people can own globally. And so I think those are reasonable questions to ask when it comes to, can you improve both the money rails and then the trading rails? And I think the only thing I would differ on is that a lot of people in the broad crypto space focus on those trading rails, those leveraging rails. And while some of that's interesting, I think the most important thing that the world lacks is a good sound money. I think that's where it's worthwhile to focus.
Mm-hmm. Yeah, that's a really interesting idea and a great stat that securities are only available to be traded, like you said, 19% of the time. Lyn, there are so many contradictory forces really looming over the year ahead here. Are there any particular asset classes that provide you with potential growth over the medium to long term here?
So I think medium term is just challenging all around because we have various, in this year, 2023, we have a bunch of U.S. recession indicators. That's partially offset by China's reopening, potential emerging market opportunities, dollars, off of its highs. It's unclear if it's going to stay there or not. And so there's a lot of uncertainty in, say, a 6 to 12 month period. I am pretty bullish on precious metals. I'm always tricky with 1 year forecast because you have to be right about the fundamentals, but then you also have to be right about what people are going to pay for those fundamentals. And that's, in 1 year, that's like a guessing game. That's, it goes back to that old quote, like, in the short term, the market's a voting machine. In the long term, it's a weighing machine, right? So over the long term, they reflect fundamentals. In the near term, it's mostly sentiment, liquidity, things like that. And so I think there are plenty of opportunities in emerging markets. If you look North America, I think that pipelines are still pretty attractive. I'm long-term bullish on energy. Unclear for this year because of some of those recession indicators, but long-term bullish on energy, precious metals. I'm less bearish on banks than a lot of people are. And then I do like a Bitcoin allocation and just select equities in different sectors that I think are recession resistant or that, might face turbulence in recession, but that are well positioned to get through it and then provide good 3 to 5 year returns from there.
Mm-hmm. I'd like to dig into some of those things that you mentioned, but before that, you mentioned that we're really this U.S. economic cycle is really pointing towards a recession later this year. So let's dig into a little bit of the inflationary aspect that we're seeing right now. Despite easing CPI prints pointing towards a disinflationary growth period, are we in a larger period of structural inflation?
That's how I view it. And if you look at the 1970s and 1940s, which were the prior big inflationary cycles, they also had periods of inflation, periods of disinflation, even though the decade as a whole was quite inflationary. Mm-hmm. And so right now, I think we are in a cyclical disinflation within a broader inflationary period. I think that, this inflationary period is not going to end until there's a big energy CapEx cycle. So you get a lot more cheap energy supply because as long as we're still supply constrained, and any sort of big growth spurt we get is probably going to come with inflation associated with it, just because the supply side is still tight. Mm-hmm. In addition, when you look at the really long-term macro, when you start to get countries, a lot of them well over 100% debt to GDP, and those debts are denominated in currency that they can print, the normal historical pattern is that you inflate the debt away, that you run inflation hot while holding yields relatively low. And, that basically you have to go back to the 40s to find a similar economic environment that we are now, as far as, say, Western, developed country sovereign debt is concerned. And so that should be a pretty inflationary trend as well. So both looking at the commodity CapEx cycle and the macro sovereign debt long-term cycle, I think both of those point towards structural inflation, say between now and the 2030s. But there are periods of time where central banks and governments fight back. In the 1970s, 1940s, you either have the central bank fighting back for periods of time, or you have things like price and wage controls trying to fight back. There's all these ways that they can hold the volleyball underwater for a period of time until something happens and they let it go, and there's another round of inflation. Mm-hmm. And so I think that's kind of a way to think about the 2020s.
So, you and I discussed shortly before we hit record here about the Fed's remittances to the US Treasury has really fallen off a cliff here towards the end of 2022. What is the significance of that development, and is it due to the tightening of the balance sheet?
So it is. Basically, the bank, in many ways, not always, but in many ways, it operates like a normal bank. They have assets and they have liabilities, and they earn a spread between the assets and liabilities. Now, their liabilities consist of banknotes, which obviously don't earn a yield if you pay for cash. Other liabilities consist of bank reserves. So much like how we hold our money at a bank, and that's an asset for us and a liability for the bank, banks hold their spare cash at their central bank, which is an asset for those banks, but it's a liability for the central bank. And so, then they also have things like reverse repos. Those are types of liabilities. So the Fed has these series of liabilities. Some of them pay interest rates. On the other side, they have assets, which for the Fed are mostly U.S. Treasuries and then mortgage-backed securities. Those are the bulk of their assets. And historically, their assets paid more than their liabilities, especially because, again, some of those liabilities were just banknotes that yielded zero. And the way it's legally structured is when the Fed earns a profit, they pay for their operating expenses, they pay a dividend to the banking system, their owners, essentially, and then they remit the rest to the U.S. Treasury. And so in recent years, they basically paid the government, the U.S. Treasury, about $100 billion a year in spare profits. And so that just goes to the U.S. Treasury, kind of goes back to the taxpayer. But because they've raised their interest rates so much and yields were so low before, now they're actually losing money. Their liabilities, obviously the bank notes still yield zero, but the interest they pay to commercial bank reserves, their bank balances at the Fed, is 4.4%. And also reverse repo payments are very high. Meanwhile, they're still holding treasuries from years ago that were yielding 2% when they were issued. They're still holding low mortgage-backed securities. And so basically, instead of paying the treasury, this is where they differ from a bank. Instead of going bankrupt or wiping out their equity and their capital, instead they're basically just giving an IOU to the treasury. They're like, well, we're not going to pay you now because we're not making a profit, and so we're just going to rack up IOUs. And then even when the Fed becomes, say, if they ever become profitable again, instead of going back to paying the treasury, they get to pay back all those IOUs first. They basically get to pay themselves back, and then they start paying the treasury. So it's kind of like a bank that can't go bankrupt, and instead you use kind of weird accounting when you go bankrupt because you're the source of the money. So it's a different situation. But the long and short of it is that a lot of people are posting those as doom charts, and the way that I've been phrasing it is, one, that's a source of income that is dried up for the federal government for the foreseeable future, right? So that's going to add to deficits. Number two, you have to ask, well, if the Fed's essentially losing money, for a simple way of putting it, who's making the money? Mm-hmm. And it's really the two pools of liability that are making money. One is money markets. Basically, they're the ones that are putting a lot of money into reverse repos. So, for example, if you look at a Fidelity money market fund, they're making pretty good yields. A lot of the money's flowing there. And number two is commercial banks. They're getting paid 4.4% for just holding cash at the Fed. And if you deposit money into a U.S. bank, you're probably getting paid 0.5%, if that, on your deposit. But on the bank's deposit, they're making 4.4%. So they're essentially earning a spread, risk-free, and they're getting pretty good income from this. So basically, now there's kind of money pouring from the public sector into the financial system, essentially.
Mm-hmm. Yeah, like you say, that's an important point to try to understand who's on the other side of that, and that's what makes you so bullish on banks at this time, right?
At least less bearish than the average person, right? So obviously the challenge with banks is if you do get a significant recession, you're going to get some degree of loan losses, right? Mm-hmm. So banks might get clipped in that scenario. I think the difference is that in 2008, for example, banks and real estate were the epicenter of that. Banks were highly levered. They had very little allocation to low risk assets, a very high allocation to risky assets. And in the current environment, obviously there's some banks with a lot of, say, auto loan exposure. I wouldn't necessarily touch those. But for a typical diversified medium to large bank, they are very allocated to cash treasuries and things like that. And they're paying very little to their depositors while getting paid a lot of money from the Fed. And then they're not aggressively allocated to riskier assets. And so they're actually in pretty good shape. Now they would still, get hurt in a recession, but they wouldn't be the epicenter of the recession. And then I would argue that they're already priced for a mild recession. And so even if you have flat to down earnings because of some of those loan losses, when they're trading at 9 or 10 times earnings, that's the market's already concerned about their forward profitability. And so I think that I'm bullish on banks with, say, a 5-year view. I think that during an inflationary cycle, they're going to make really good spreads. They're going to be pretty profitable. But I have, concerns around a 6 to 12 month view. But I don't really expect them to crash in a sort of a financial crisis scenario.
You brought up the loan idea. What is the correlation of bank loans to the yield curve, and what is the significance of that relationship?
So historically, it's been on a lag. Basically, when you get the yield curve inversion, usually you have the rate of change of bank loan growth roll over in the subsequent quarters. And I think we're seeing that now. Basically, you have an inverted yield curve. Bank lending's still been strong in these past 2 quarters, but it's showing signs of topping out in rate of change terms, which essentially means that the absolute amount of bank loans is still going up, but the rate that it's going up is starting to roll over, which is historically, not very good for business growth.
Mm-hmm. So, Lyn, do you see energy production and distribution playing into the next wave of inflation?
I think that's one of the key bottlenecks. So part of this recent inflation spike, part of the severe level of inflation was impacted by how quickly we changed our buying patterns, right? If you're locked at home, you can't go to restaurants, you can't travel. Travel's a burden. You have to get all this paperwork. Some countries just shut down travel. So you're like, well, I'm gonna get all this electronic equipment. I'm gonna redo my home. I'm going to redo my appliances, consumer durables. So a lot of the spending shifted away from services and towards goods. But then a lot of people saturated. They already got that out of their system. Then the economy reopens and it's easier to travel, less paperwork for traveling, less test requirements, things like that. People are going out to restaurants. People are traveling more. They're spending less on consumer durables, consumer goods. And so those can stress supply chains a lot, right? So that I think is inherently temporary, because you're not going to have that big whipsaw keep happening. That was like a very odd lockdown related, 2 to 3 year situation. But the part I think that's going to be sticky is the fact that we're just underinvested in energy in a global sense, right? So OPEC Plus is not really able to bring a lot more energy online. North America, we've gotten a lot of the easiest shale deposits. For a while, due to ESG, they're like, banks shouldn't lend to, oil companies, and like pools of capital should stop investing in oil companies. So it raises their cost of capital. So they're like, well, instead of keeping the drilling, we're going to focus on paying down debt. We're going to, pay bigger dividends to shareholders. We're going to be self-financing. We're going to be profitable, and we're going to finance our own capital expenditures, because we can't rely on these external pools of capital, just, always buying our equity and debt. And so basically that will incentivize less, overall less drilling. And so I do think in this decade, and we've already seen a taste of it, especially in Europe, but I do think we're going to get waves of energy crisis, just because the supply side is still very tight. So when you try to get a big growth spurt, you're quickly going to run into constraints on energy, and that's an inflationary situation.
So, one of the ideas that is not a lot of people think about is the energy return on investment, or EROI. Do you see this as a real problem facing the world, and what sources of energy best address this equation?
So basically, part of the growth of civilization, humanity, over the past 2 centuries is our tapping into denser and denser energy sources. Mm-hmm. And so if you go out and chop wood, bring the whole wood home, and you use that to burn, you heat your home, you cook food, you power something simple, that gives you a certain return on energy. So you spent 1 unit of energy, right? Basically food energy, the work of the man that went out and chopped it all up and brought it back. But you're getting a multiple of energy back. Maybe you're getting 5 times as much energy from the burning of that wood than the food of that man that had to go do it all. When you tap into coal and you tap into oil, you tap into gas, you're getting a higher multiple. For all the energy that you have to spend on equipment and setting up an oil well, you're getting a much higher multiple of energy out of that oil well. And of course, the highest is nuclear. If you do a nuclear facility, you can get upwards of 100 times your energy back, from the uranium, but also from the construction of the complex facility. They can then run for 75 years, and you get a very large energy return on investment. Solar and wind and biomass don't have very high energy returns on investment. Basically, you put energy in, you do get a multiple back over the long term, but it's not as high as a multiple as hydrocarbons or nuclear. And so essentially that, if we trend towards lower energy return on investment types of sources, we're likely to have inflation. And it's somewhat disguised by the fact that, people will point towards, say, negative energy pricing for solar, right? That, basically that in some contexts, say solar or wind can be unusually cheap. And they're like, well, that's the future. The problem is not that they can produce very cheap energy for parts of the time. The problem is that they're usually paying out energy when you don't want it, right? And that's why it's free or negative, right? Because it's basically, if the sun's on, you can get a lot of extra energy, but then when you need energy in the evening, where are you going to get that energy from? Same thing with the wind. I mean, basically, if you have a super hot day, everybody turns on the air conditioning, the wind goes out. What happens to all your windmills? And so the problem is that storage is very expensive and uses a lot of battery metals, and it's not economical. So that changes the equation. It's usually not fully included in the marketing or the kind of promotion of those types of energies. And I think a last point to think about is that the more you let nature store the energy and concentrate it, the more efficient it's going to be. So, for example, let's say a hydro dam, for example. Where does the energy for that come from? Well, it's a combination of, it's mostly solar, but it's concentrated solar. So basically the sun is sending all this energy on Earth. It's evaporating water over a very large distance. Then it's raining. But then because of geography, because of gravity, all that is collecting into rivers and flowing into bigger rivers. And it's concentrating all of that pent-up solar that evaporated that water in the first place. And then right at that concentrated point, at that big river, we put a dam. And then we capture what is essentially, indirect solar power. But we let nature just, do a lot of that concentration for us. We're gathering this energy over a very large area that's all been channeled through this river. Mm-hmm. Whereas when you're trying to, say, capture it with a solar panel or a windmill, you're not capturing concentrated, stored up energy. You're capturing the flow. You're capturing like a less dense flow. And so the problem is then, how do you store it? Well, you have to make your own storage. You have to go out and get battery metals, and you have to make your own storage. And so that's where you're essentially trying to replicate what nature does with these other sources, whether it's hydro, whether it's hydrocarbons, nuclear. These are all very dense stored types of energy. And there are some interesting renewable ones that are pretty dense and stable, like geothermal. There's one called ocean thermal energy conversion, OTEC. Basically, you can get like base load power from the difference in say hot ocean water surface and colder depths. It's kind of a 100-year technology. It's not just it's in my view, it's undertapped. So there are renewable forms that are dense, but the general rule is that a lot of them aren't, especially wind and solar. Whereas hydrocarbons and nuclear are the ones that have been, these reliable sources that let nature do as much of the concentration and storage as possible.
Have you done any thinking around the base EROI number that we need to see to continue the current economic path that we're on? If we're expending too much energy to be able to gather energy, what does that base case look like, do you think, where it starts to hamper our ability to continue enjoying, let's say, the current lifestyle that first world countries have versus expending so much of that energy to gather more?
So it's a good question. It's going to vary depending on what exactly you want to do. You need a higher energy return on investment if you're trying to grow rapidly, mm-hmm. right? So if you're India and you're trying to go from 2,000 or 3,000 GDP per capita to 20 or 30,000 GDP per capita, basically expand your per capita energy usage by 5x, you need a very high energy return on investment. On the other hand, if you're a wealthy country that already is very energy abundant, and you're trying to basically keep what you have and grow more slowly, basically you already have a lot of your material comforts done, and now you want software, you want travel, you want media, things like that. That's going to grow more slowly, and you can get away with lower energy return on investment as long as it's stable and as long as it's not too low, right? You still need some reasonable multiple, and so there's no exact number that's going to determine what everybody needs, because it really depends on how quickly you're trying to grow from whatever base of growth you're at. But basically, once you get down into the single digits, you're more likely to run into challenges, especially if you're still trying to grow at a reasonable pace.
Mm-hmm. Has humanity ever transitioned from a high EROI energy source to a lower EROI energy source?
Not yet. I mean, basically, for thousands of years, we were using pretty low energy return on investment. You also had low population growth during that time. I mean, you had pretty stable global population. And then with the discovery of coal and then oil and gas, nuclear, you had this big, rise in all these energy sources. You had a big corresponding rise in population, because one barrel of oil, even though, it's under $100 right now, that gives you thousands of man hours worth of energy. Basically it's, it's like imagine how many people you'd have to hire to run a bicycle to power all your lights, power your heat, power all the facilities that manufacture all the stuff, power all the trucks that bring that stuff to you. We basically all have the equivalent of dozens of laborers working for us, but it's all the form of hydrocarbons and automation and things like that. Mm-hmm. And so that's really the key challenge there overall. And the world's only gone up in terms of energy return on investment, and only really in the past, you could argue the past say couple decades, we've been kind of flatlining there, where we're trying to go more into wind and solar. The developed countries have kind of shunned nuclear, and now I think we're running into some challenges. But even then, that's been offset by the fact that the developing countries are still going full speed ahead with coal, oil, in many cases hydrocarbons, nuclear, things like that. And so overall, the world's only gone higher in terms of energy return on investment. It's never tried to transition to a lower energy return on investment way of looking at it.
How do transportability and payback period also factor into the thinking of the best sources of energy available to countries that are either trying to grow and or trying to maintain what they have?
So energy return on investment itself doesn't measure how quickly you get that energy back. And so another factor to consider is the payback period, like you mentioned. And so, for example, you can imagine two types of energy sources. One, you get a 20 return on investment over 5 years. And you get another one where you put in the same amount of energy and you get a 30 times payback, but it's over 10 years, right? And the question is, which one should you pick? Well, if you're trying to grow very, very quickly, if you're India, you probably pick the first one, right? You want energy now quickly, and then you can use that to make even more energy, and you can go up more exponentially. If you're already a wealthy country with slow population growth, and there's this less overall rampant demand for more and more energy. I mean, still people always want more marginal energy. I mean, if it was really cheap to fly private jets, I would, right? But it's not, and so we always have to economize. But for example, when you're you're coming from a small base, small changes in energy, like a small doubling of your energy, rapidly changes your life. Whereas once you have a lot of energy, a little bit more doesn't really radically change your life. And so in a developed country, probably that second option is better. You're saying, well, we can put in energy, we can get 30 times as much back, and that's fine because we already have pretty much all the energy we want. We're just trying to grow slowly, and that's fine. Mm-hmm. And you're probably going to get better, unit economics of that energy. And so that's why, for example, in a lot of developing countries, you'll see a lot of coal usage. And the question is why? And it's not that hard to build a coal plant. It's quick. You don't need advanced expertise. You build the coal plant, you get a lot of energy quickly, right? Whereas a nuclear facility, it might have better energy return on investment, but that's going to take years to build. It requires, there's only a handful of entities in the world capable of constructing these. And then it's got a very long payback period. So it's a really good long-term investment, But some countries are in such impoverished state, or they're trying to grow so quickly that they're not in a position where they can rely on those long-term investments quite yet. And instead they pick the more rapid turnover, the coal plants, the natural gas plants, things like that.
Are many of the current ESG frameworks that many companies are operating under not properly analyzing the trade-offs of these different energy sources?
I think that's how, yes, I do, because I think a lot of them are just focused on the cost of the energy and not the benefits that they provide. Especially in the developing world, I mean, having energy or not having energy is often the difference between life and death. It's the difference between being able to, your crops are starting to fail because of drought. Do you have enough energy to get water and irrigate them? There's a disaster that struck, a big storm struck. Can you get food in? Can you do all that? Even like things like sewage and all. Part of why we had such a big population growth is because we have running water, we have water cleaning. All this is energy intensive, and it reduces our exposure to diseases. It increases our nutritional quality, unless we start going down like industrialized food processes, which unfortunately we've done. But essentially, we have better access to things we need to survive, and that's, I think, not factored enough into these ESG frameworks. They're kind of these one size fits all approaches, and I think people don't realize, like, if we were to have a severe disruption to our energy production, that would kill a lot of people. I mean, that's about the worst ESG thing you can do. And so there can be impacts from pollution, obviously, from certain things, but then there's also, countries go through this development process and they have to get the energy that they need in order to expand their quality of life, expand their life, their lifespans, make it possible for, premature babies to survive in hospitals, and they need all that reliable energy to get through that period. All that comes from having, abundant, reliable energy.
So does the lack of a robust CapEx cycle, has that really plagued the development of the oil sectors to continue the development in this sector that is so precious and needed at this time?
So partially, I think, so it depends on what timeline you look at. I mean, even in the 2010s, which was not a period of in most places, energy development, in North America, we had shale. And so we brought a lot of shale oil on quickly. And part of that was because of basically no cost of capital. So most of those companies were not profitable. They were growing quickly. They were not earning, free cash flows. And they were relying on all these investors pouring money in, buying their debt, buying their equity. And when that started to dry up, now we're getting kind of a challenge in the shale patch, especially because you've also sucked out a lot of the lowest hanging fruit. You've gotten a lot of the easiest shale deposits, and now you're kind of moving on to maybe the less ideal ones. There's still growth ahead, but it's not as quick as I think we're accustomed to. And so once you kind of tap out shale, not that it's going to go away, but it's just going to maybe stop growing. Then the question was, where does the marginal barrel of oil come from globally? And of course, there are more places to look. You can expand oil sands. You can go in the Arctic. You can go in the China Sea. There's multiple more places to get it. There's places around Africa you can get it. But essentially, some of the oil that's left is just harder. Either like in terms of geology or in terms of geopolitics. And then also when we've kind of hampered ourselves from going to get it, basically, I think we're just due for another CapEx cycle. And to the extent that we resist doing it, we're going to get these recurring inflationary spikes where, maybe when we're slowing down, when our economy is kind of in pseudo recession mode, we can avoid inflation because we're not really using more energy. But if we're going on another growth cycle, those energy supply side constraints are still there. And so I do think that it's going to be a challenge. And then also, some of these countries have done things like windfall taxes on energy companies. And if you're an energy major and you're planning about your capital expenditure budget, you're like, well, I don't even know how much of the profits we're going to get to keep. We have all the downside risk from developing a new project, but we have unclear upside potential of how much of that we'd get to keep. And so maybe we should just, buy back more shares, pay more dividends, strengthen our balance sheet. And that, basically changes the incentive structure for how, CEOs want to manage their companies.
Do you think that that has really affected the metals miners as well as a real lack of a CapEx cycle to bring more metals into production?
So I think so, but it's, both oil and copper, I mean, they're still off their like long-term highs, for example. And so it's not really gotten super severe yet. I think it's really that it's still building, right? I mean, it's hard to bring a new copper mine on. I mean, obviously it happens occasionally, but it's basically hard to build them as quickly as they used to be built. There's all sorts of environmental regulations, and a lot of those countries, it's understandable. I mean, basically, there's a history of, rich countries coming in, basically getting all their minerals and like leaving them with the mess, and not necessarily a lot of the profits. And so you have this, this kind of, this trade-off that always happens. And basically, I think we're due for another CapEx cycle in copper and a number of other things. And it shows up in some markets before others. And so, for example, gas is not a portable market. It's a much harder, it's not like you have one global natural gas price, right? Gas is a very localized price. It could be, 5 or 10 times higher in Europe or in Japan than it is in North America at times, sometimes even higher than that during the worst part. And that's because, in order to transport gas, you have to hyperfreeze it, transport it on specialized ships, and then unfreeze it. It's a very specific process. There's only a finite amount of capacity for that. Whereas oil is pretty easy to ship globally. So while there are a handful of different oil prices, it's a more global market for oil. It's a more fungible pricing market. And so we've had some of the energy crises show up in the less fungible energies. So oil never reached its prior highs, even when it was up to 120 barrel. That was not its high. Over a decade ago, it was higher than that briefly. Whereas natural gas did get to extraordinary heights over in Europe and Japan. And so I think that, later this decade, the concern is that you could have a similar spike in oil that you saw in gas, that basically, it's not gotten super bad yet. But if we continue to underinvest in that space while the global growth continues, if India keeps growing, if parts of Africa keep growing, parts of Southeast Asia keep growing, all these people from a low base of energy usage still growing up and kind of catching up to the developed world, that's a higher average base of energy consumption. And I do think we're likely to run into a more severe energy crisis in this decade if we don't get ahead of it.
Mm-hmm. Lyn, do you think that the mining of precious metals constitutes a smart way of expending energy that is possibly becoming more scarce?
So I think as long as people desire precious metals, then yes. I mean, obviously you need precious metals for certain industries. Mm-hmm. And, gold, a large portion of it is jewelry and savings. But there's a smaller part that's used for industry. But as long as people want it to save, because of, if the alternatives like, fiat currencies, they're going to do it. And, Bitcoin's an interesting option, but it's a 14-year-old technology. It's volatile. Not everybody understands it. Not everybody, has concluded that it's a good store of value. And so, there's gold. And that's why I like a mix of different assets. As far as becoming more scarce, I mean, essentially, gold is still near its all-time highs for annual production. When you look at like a 50 or 100-year chart for how much gold is mined per year, it's generally an upward trend. Mm-hmm. But the neat thing is, I remember seeing a chart from NYDIG that showed gold's estimated supply inflation rate over a century, which is basically how much is mined per year compared to how much is estimated to exist above ground. Mm-hmm. And it was actually extremely stable between 1% and 2% per year, almost like clockwork, averaging around 1.5%. Mm-hmm. And so if you look at global fiat currencies, I remember the economist Safety Amus, he did research and showed that the weighted average fiat currency in the world over the past X number of decades, I forget his exact timeline, let's call it 50 years or so, grew at something like 14% supply inflation per year. Now, obviously, you have some of the developed countries you're growing at maybe a high single-digit pace per year on average. Some of the other countries you're growing at 20, 30% or more. Some of the more inflationary ones averaging around 14%, whereas gold is averaging 1.5%. Supply growth per year like clockwork. And so that that could change in the future. But that's partially what's made it good money for such a long period of time. Is it is very hard to rapidly expand its supply no matter how good our technology gets.
Mm-hmm. I was actually thinking that the energy is becoming the more scarce commodity. Is that something that you think is happening, or is it just the energy that is easy to get to?
So I think that, it's funny, if you look at debates about the gold standard from like a century ago, there are people discussing whether or not it's a waste of energy to get all this gold. And it's but the proponents of it were like, no, we need sound money. I mean, basically that energy expenditure is why this money stays scarce and why you can't just print more of it. And so I do think I think markets price it as long as people want it. I think it's worth spending energy on it, unless or until there's a better way. I think the same arguments kind of apply for Bitcoin. Some people complain about Bitcoin's energy usage. Say, well, Bitcoin is providing this global network of payments and savings, and there's millions of people that want to use it, and so it's being used in that way. So I do think that some of these industries can run into energy, problems. It can certainly affect their bottom line, but I think that as the market can dictate what is a important use of energy. I mean, I think gold mining is still a useful form of energy. I think Bitcoin mining is a useful form of energy. I think that flying around, meeting people is a useful form of energy. Heating your home is a useful form of energy. Obviously, there's almost like a Maslow's hierarchy of needs. But I actually think that good money is one of the foundations for what people need to expend energy on.
Mm-hmm. So Lyn, as we look forward to this coming year of 2023, what are the biggest question marks that stand out to you that could affect any of your investment theses this year?
I think a key thing to watch is the dollar index, because right now most signs point towards worsening U.S. domestic liquidity. So as long as the Fed continues to draw down their balance sheets, you're likely to get, unattractive domestic liquidity conditions. That's offset by the fact that China is trying to reopen, and that the dollar is off of its highs. And so actually global liquidity indicators are up, because a lot of those are tied to the fact that the dollar is weakening. That's generally good for a lot of the world that has dollar-denominated debts. Mm-hmm. And one thing I always like to remind is that most of those debts are not owed to the United States. It's like China literally lends dollars to countries in Africa, and Europe, the countries and entities in Europe lend dollars to entities in South America, for example. So even though they're dollar denominated, they're actually owed to various foreign entities. But essentially, when the dollar is weakening, it means that the liabilities of a lot of entities around the world are weakening, which is it's good for their growth prospects. They're able to basically expand more. And so I think the biggest thing to watch that can affect overall recession risk, or maybe the comparison between U.S. assets and foreign assets, is what happens with the dollar. If other countries are able to tighten more, if they're able to reopen more, and if the U.S. kind of stagnates, you could have maybe a less severe recession in the U.S. than you'd expect, because it's partially being pulled up by that foreign activity, and you could have that divergence. On the other hand, if the dollar spikes again, you're likely to get a more disorderly market conditions globally.
Yeah, very, very interesting and important things to look at there. Of course, all of the kind of topics that we talked about today are available on your website, the articles that that we based this conversation on. Lyn, is there anything else that you think we should touch on before we wrap up today?
No, I think we covered a lot. I think that I did write that energy piece on lynalden.com. People can check out. That's like a long form piece. It's not one of those pieces that's like telling you how to trade in the next 6 weeks. It's basically trying to discuss in depth how energy works, so that people can kind of understand at a deeper level. Mm-hmm. But I think we covered a lot here. It's basically there's so many dynamics related to energy, related to central bank financing. And I think that most of them point towards long-term inflation, but it's about you still have to navigate the next year to make sure you're in a good position to get through, the rest of the decade.
Yeah, you have to not get killed over the next year to stay in the market, right?
Exactly.
Wonderful. I'll make sure I put the links to those articles in the show notes. As you said, those are available at lynalden.com. And of course, your Twitter handle is @LynAldenContact. Lyn, thanks so much for your time today. Really appreciate the in-depth discussion here.
Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.